Hello, everyone. Today on the final bar, my guest is Katie Stockton from Fairlead Strategies. We'll look at sort of a long-term view of the market. One particular indicator that has recently registered a long-term sell signal. We'll see how the short-term dynamics fit into that long-term signal. Overall, the S&P, the NASDAQ pushing higher today, onward and ever upward, trying to regain those previous all-time highs. Our 4550 plus in store for the S&P soon. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of technical analysis, behavioral finance, investor sentiment, psychology, all the tools we can use to try to make sense of what investors are thinking, what they're saying, and most importantly, where they're voting, what they're communicating through the movement in their capital. And Richard Russell, who is the editor of the Dow Theory newsletters for years and years, over 50 years, if I remember right. I'm going to completely butcher his quote. Probably it was something like the worst violation or the worst foul an analyst can make is remaining bearish in the face of a rising market. So we've talked about the breadth deterioration from April, May through the fall. We talked about the market peak in September, how it rolled over. And we talked about the potential prospect of the S&P going materially lower, what that might look like. However, we're in a situation this week where you see renewed strength from stocks. You see the S&P making, new swing highs, continue to push higher and higher. You're seeing plenty of traditionally offensive categories that are moving higher. Although a day like today, you actually had Utes that were almost at the top of the list, utilities. So it's a bit of a mixed bag, but overall, it's undeniable. Stocks in general moving higher than the S&P following suit and certainly pushing to the upside as well. We're going to dig through as many of those little themes as we can. We have great guests on the show. I'm excited to talk to Katie Stockton here in a little while. Tomorrow on the 20th, we have Mish Schneider from Market Gauge. On Thursday, the 21st, Craig Johnson from Piper Sandler in Minneapolis. Coming up next week, on Tuesday, the 26th, Roman Bogomazov, founder of Wyckoff Analytics in San Francisco. And then on Wednesday, co-host of the Market Huddle podcast that I've enjoyed going on, Pat Cerezna will be joining us on the show. Also, just to let you know, the next episode of The Pitch is coming up on October 27th. Go to stockcharts.com/thepitch. My friend Grayson Rose will be hosting a really fun conversation with Greg Schnell, Mark Newton, and Jay Woods coming on the pitch for the first time. Should be a lot of fun, and check that out if you're interested. Let's get to today's market recap. We're going to start with a poll we asked you all recently. Which sentiment survey is based on responses from a relatively small number of individual investors? I'm tickled that I got 11% of you to answer the DK survey, which I purely made up for this one, although it's inspiring me to create a DK survey. I don't know what I would ask there, but I'm looking to look into it for sure. 72% of you absolutely right. That's the AAII survey. And there are a couple different ways you can look at survey data, and I've listed 3 of those. Market Vein is another one that's a little more thinking about, some are a little more geared towards futures traders, some are a little more geared toward institutional investors and letter writers like Investors Intelligence. The AAII survey is actually based on individual investors. It's a weekly survey where they invite their members to vote bullish, bearish, or neutral on stocks. And I think while it is certainly an imperfect exercise in understanding market dynamics and investor sentiment, it is a great long-standing data set that helps you understand what sentiment, how that evolves around major turning points. And for that, I think it can be worth paying attention to. Let's continue on with today's market recap. The S&P, as I mentioned, up about 0.75%, closing just below 4520. Mid caps and small caps were far outpaced by large caps. The S&P, the NASDAQ really drove the way higher today. Mid caps up 0.25%. Small caps were essentially flat for the day, and that lack of participation in small caps. So look at the Russell 2000. It's essentially a flat chart since February or March, depending on how you want to look at it. But overall, really haven't seen that upside follow through. And it's been underperforming, particularly at times when the growth trade is really working relative to the cyclical trade, the value trade, really. So it'd be interesting to see if you do see an upturn in small caps. And I would think if you buy into the infrastructure trade, the stimulus trade, that would most likely be reflected with small caps doing a little better than we've seen so far. The VIX, by the way, back below 16. This had been up in the mid-teens not too long ago, continuing to come down, and now entering or nearing the lower end of the range we've probably seen for quite some time. Other asset classes, very quickly, interest rates continuing to push higher. I was on an interview yesterday, and I was asked about 10-year yields, and asked can yields get above 175? And my answer was same thing when I was asked year plus ago, when I was asked, could 10-year yields go below 1%? The answer is, yeah, they can go a lot lower. Can they go above 175? Of course they can. I'd much more be focused on the trend. And if you look at the trend in rates, certainly seems to be higher rates, lower bonds, and think about what that does for the financial sector, which is why in general, the relative strength of the XLF has been improving. The dollar index down about 0.25% today. Other asset classes, we have precious metals higher, with gold higher. Really, the GLD was up a lot more actually earlier in the day, but settled back down, up about 1/3% by the end of the day. Silver prices up almost 2% as all was said and done. Finally, we have cryptocurrencies. It's sort of a mixed bag when you look at the daily movements, but if you look at the chart of Bitcoin, you can see why this is certainly emerging. There was a period not too long ago where I was asked about Bitcoin versus Ether and looking at the differences between them. And my answer at the time was Ethereum is basically far outpacing Bitcoin. It certainly seems like the better bet at the moment. That's changed. And when I've been asked recently about that, it's been a lot more talking about Bitcoin, again, based purely on the technicals, purely on the chart. We're now approaching all-time highs, right? 64,000. That was sort of the level we've been keying in on for quite some time. It literally has now round tripped from 64 down to 30 and back up to 64. Let's go to that chart here for a minute and just spend a moment or two talking about that. So this is where we were in April. Remember when we accelerated above 20,000, 30,000, 40,000. I'm highlighting those particular levels because look at how often those big round numbers have served as key support and resistance. Most of the time, we found turning points around some of those major values. We continued higher, push up to the previous high in April, just above where we're at right now. We over halved the value of Bitcoin, going down to a low around 30,000 into May, June, and July. From there, we bounced higher and now pushed above 50,000. That green horizontal line, I think for me, was the indication that things were really starting to improve. The bounce off of the lows, clearly meaningful, but when we failed to get above 50,000, that next big round number, that was a cause for concern. Finally propelling above there and now following through to the upside tells you, I think, there's quite a bit of upside to be had for Bitcoin, assuming we can get above this range. And I don't have a big shaded area of here, but I probably should. Sort of that 60 to 65,000 range. That's where we spent 3 months of time back here in March. Again, when we hit those highs in March and April, felt like we were going to go to the moon. From there, we kind of came off. And so make sure we're able to eclipse those previous highs. 65K would give an all clear. And I think measures much, much higher. A simple measurement doing the height of this pattern and projecting that higher, that puts you to around 98,000 or so, based on the height of that pattern, around 34,000 points. So certainly some further upside and no resistance left on the chart if we can get above 65,000. Now, a chart of the S&P 500, we need to think about the overall sentiment, right? And I think when you're thinking about the S&P, it's all about trend. Are we making higher highs and higher lows? Are we making lower highs and lower lows? Answer that question first. All the other questions can be answered after that. In the long-term time frame, if you take a step back and just look at the trajectory of stocks, it certainly in the long-term time frame seems fairly constructive, right? If you think of these monthly highs and lows, we've undercut the August low there in September into October, but overall, we're not far off of all-time highs at 45.50, continuing to push to the upside, back above the 50-day moving average, which I think is really meaningful. So now we've made a new swing high. We've arguably made a higher low, depending on whether you think that low from last week was enough to sort of indicate a higher low from October, but certainly on that tactical time frame, that short-term time frame, weight of the evidence is fairly positive. I think on the long-term time frame, the ultra long-term, the market trend chart that we usually look at every Friday, undeniably in a bullish phase, continuing to push higher. What concerns me is that medium-term time frame. If you look at the weekly PPO, it turned negative in May on the S&P 500, has remained negative this whole time. And while that's bugged me at times that a medium-term model is negative while stocks are going higher, depending on what chart you bring up, that's about when things really started to deteriorate. That's when the breadth conditions certainly deteriorated. When you look at the advanced decline lines, look at the percent of stocks above their moving averages, those all peaked in April. in May, if I remember right. And then from June on, we've sort of rotated lower. So while the indexes have overall moved higher, there's been plenty of weakness underneath the hood. The question now is, do we eclipse 45, 50? Do we make new highs in the S&P 500? Does the momentum continue to improve? And we got just above 60 today. So this week, we're now getting the RSI back into a bullish phase where the RSI goes above 60 on a rally. I'd be very keen to see if the RSI can get above 70, which would be an overbought condition, which I would argue, while it could suggest short-term overextension, overall, I would think that's one of the more bullish indications you can get, which tells you there's enough buying power to push the S&P onward and ever upward. Looking very quickly at some other asset classes before we take a quick break, looking at sector rotation, healthcare and utilities were number 1 and number 2. Utes are an interesting one. The relative performance in utilities has not been super exciting. Utes are definitely more of a defensive play. But however, there have been plenty of times when the market rallies and things like utilities or real estate do just fine. So I would think a lot less about what should happen and focus on what is happening. But certainly the trend in utilities overall weaker on a relative basis. And I think looking at the RRG clarifies that more than anything. Another interesting theme today, the only one of the 11 S&P sectors down today, consumer discretionary. Now, again, it's coming off an all-time high yesterday after a series of all-time highs and gaps higher. So I don't think this is something to worry about just yet, but certainly one of the few days in recent history where staples have done better than discretionary. A lot of that could be the market caps and some of the larger names in consumer discretionary, but certainly something to pay attention to. That ratio of consumer discretionary versus consumer staples coming out of a serious breakout in the last week or two. Let's take a quick break. We'll be back with my guest, Katie Stockton. We'll see you in a minute. Everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the trends of the markets using the power of technical analysis. A couple quick comments before we get to today's guest, Katie Stockton. First off, we love to get your questions, particularly questions you are running into as you're analyzing your own charts. What questions come up as you're using technical indicators, looking at particular ETFs or stocks? Let us know. Our email is thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'd love to hear from you and answer one of your questions on the air in our next mailbag segment, which will be on Friday's show. Also, go to StockChartsTV.com. That is our free on-demand platform. You can access all of our great content. Fantastic guests like Katie Stockton and others, special events like the pitch in our year in review coming up in December, and much, much more. Go to StockChartsTV.com or search on any of the app stores on your mobile devices for Stock Charts TV on demand. I want to welcome on today's guest, Katie Stockton. Katie's the founder of Fairlead Strategies based in Connecticut. Always a pleasure to have her on the show. Katie, welcome back today.
Thanks so much, Dave.
So when we're thinking about this overall environment, I shared a quote from Richard Russell earlier in the show. It's one of the worst penalties an analyst can do is remain bearish in the face of a rising market. And I feel like that's what we've seen, right? We've gone from a pullback phase to potentially an emerging new uptrend. Start us long-term with the S&P. How are you making sense of what's going on here?
Well, as always, it's really important to reconcile the timeframes as we've discussed in the past. So the short-term up move definitely improves the charts here and potentially even into year end. We've seen definitely sort of a turnaround, if you will, in our intermediate term momentum gauges with the relief rally that we've seen. So that's very promising. We also have renewed upside leadership from the mega caps, and that of course should help the major indices forge higher. However, on a long-term basis, we think perhaps that the market will face more difficulties next year. And we say that for a couple of reasons, of which I think they're best viewed on the monthly bar chart. On the monthly bar chart, we have denoted on the bars themselves something called the TD combo model. So this is one of Tom DeMark's indicators, and it's designed to gauge trend exhaustion. And for the first time since this uptrend began, we do have a counter trend signal from that model. They've had a mixed record in the past, so they're not perfect, nor is any indicator, as you know. And yet it does create a bit of an overhang, suggesting that perhaps the market is stretched coming into the new year in a similar fashion to what we saw in late 2017, ahead of what was a more sort of range-bound, volatile environment in 2018. I don't want to minimize the fact that long-term momentum is still very much positive, but it has decelerated to some degree over the past 2 months. And that perhaps is just a function of the prolonged overbought reading. But if we were to see this signal manifest itself early in the new year, I think we can expect some more volatility.
It's great thoughts about the timeframes and the relationship of those, Katie. The second chart is thinking about the NASDAQ, and certainly, at times the NASDAQ has been the place to be. Certainly has done very well relative to the S&P, but a bit of a choppy record recently. What's your take on the NASDAQ here?
So it has been stair-stepping higher, and the next step seems to be higher indeed. So it's extending its uptrend here. And I love the cloud model and how it denotes the trend and even gives you a sense that it should move gradually higher going forward. And it's also acted as support, but there's a lot of room to that cloud, right? So you could see more of a range-bound environment perhaps from the NASDAQ 100 next year and still maintain that long-term uptrend. Importantly, the takeaway here from this chart is the relative strength ratio. If you compare the NASDAQ 100, which is really tech heavy and really weighted more so towards those FANG plus Microsoft plus Tesla stocks than the S&P 500, also shows a bit more of a growth rotation. We had been equal weight technology and now are moving back to overweight because we anticipate a breakout near term for the NASDAQ 100 index in that ratio versus the S&P 500 index associated with upside leadership from those FANG stocks and the mega caps in general. That, of course, could foster more growth rotation, but we think it could be somewhat short-lived, associated with that same sort of signal that we highlighted on the monthly chart of the S&P 500, something that you see a nice push higher, enough to take advantage of it, certainly from a trading perspective, but something that you want to be somewhat non-committal to.
You're reminding me to keep the timeframes in mind. You're bringing monthly and weekly charts, making me feel very guilty about bringing up anything shorter term to make sense of what's happening. Now, volatility is certainly an area that a lot of people have been focused on. The VIX has come off of spiking into the mid-20s, even a little bit higher, now coming back and in the mid-teens. How does this put all these movements we've seen into context for you?
Well, what's the gift from the VIX is that it's this very tight and well-defined trading range. So we have good levels to watch, right, as sort of a risk metric. VIX above 25, of which it just couldn't get through recently in the September downdraft. Above 25, we should be getting into more of like a high volatility regime. It would suggest that it's a more emotionally charged environment that we have at present. Yet, if we see a breakdown below that 15 level being support for the VIX, that would suggest that the low volatility regime that has characterized the market for more than a few months is here to stay. My sense is that we'll see that 15 level probably hold, but remain range bound through year end, perhaps until we get into those issues that we highlighted earlier.
So we're only about 30 seconds left, Katie. This has been fantastic. When you think between now and year end, you mentioned the NASDAQ moving higher, some of the growth trades. Where do you look opportunistically right now? Is it something like Microsoft, sort of the mega cap trade that may be reemerging, or there is an opportunity, an area that you would look for?
Well, we look for names that are relatively oversold, and that does actually include those mega caps. I think Facebook is perhaps the best example of it, having pulled back significantly and now seemingly reacting to intermediate term oversold readings. So I think it's those oversold stocks that will do better than the likes of, say, the energy sector that has done very well recently, because those might be penalized as sort of a source of funds to get more involved again in those technology or growth names.
Fantastic. Katie, it's awesome to see you. Thanks for coming on the
Thank you.
show. I appreciate you sharing a good long-term perspective. Stay safe, be well. We'll talk to you again soon.
Thanks.
That's Katie Stockton. Katie's the founder of Fairlead Strategies in Connecticut. Does a great job. I think if you look at the charts she brought, I love how I ask my guests to just bring charts that are top of mind for them. What's going to help them put things into proper context? If you look at what Katie brought, some really long-term charts. We're starting with a monthly chart of the S&P, and it reminds me, and hopefully reminds all of you, to keep a proper time frame in perspective. It's really easy, particularly in periods of market dislocation. We have some short-term movements, some fluctuations, to get caught up into the flickering ticks, what I'd call the short-term movements in the market. Look at the long-term picture, and I love how she was talking about the long-term, the overhead potentially in the market with the monthly TD combo signal. I've not paid a lot of attention to that, and I certainly will going forward. Let's continue on today's show with the final bar mailbag. As I mentioned, we love to get your feedback on how we're doing, feedback on the content, the guests, our hosts, but particularly questions that are coming up as you are analyzing your own charts. Our email is thefinalbar@stockcharts.com. Keep the questions coming, and let's get to some of the ones we've received recently right now. Question number 1. For the S&P 500, why can't the recent low be the end of the C wave? What was the logic that we're only halfway down? That was actually a question we got after Clint Cowles came on the show. Well, this was last week, and I forget what day it was, to be honest with you, but he brought this chart with him. If I can bring it up, here we go. So this is his Elliott Wave count, and as you probably know, or if not, I'll tell you now, I'm not a huge Elliott Wave user. You will very rarely, if ever, see me bring up wave counts, probably never, although I'm very familiar with it. I'm able to speak the language probably pretty well, but it's not a core part of my toolkit. But I have always found talking to guys like Clint that are big Elliott Wave aficionados can be really helpful, just to see how what they are doing relates to what I'm doing, and see what sort of similarities we can find. And the question was, how come, what would you need to see basically for that wave C move? Let me bring up the question here again. What's the logic that we're only halfway down? And I actually asked Clint, I emailed him this question, and here was the response that he gave me. I'll read it to you very quickly. The most common relationship in corrective waves is A equals C, meaning that first wave down would be the same distance, the same amount as that third wave down, that C wave, following the guideline of equality. However, it's just a guideline, not a hard rule. Another common target for a fourth wave is the fourth wave of one lesser degree, in this case, the July 19th low. Oddly enough, the A to C target and that low are both around S&P 4230. So in a perfect structure, the C wave would carry a bit further down, but the recent low absolutely could be the end of it. And with today's rally, it's looking like that's much more probable. That was, I wrote him that on Friday, and that was the response he gave me. And so just to review what he was saying, which is, the way that this is, the reason why he was saying this is maybe only halfway down, because in general, there's a rule in Elliott Wave called the rule of equality that waves A and C are usually about the same amount. So if this is wave A down and then wave B up, wave C should be about the same distance as wave A, which means we would have a little further to go down. And that lines up with some of the previous lows on here. However, what I like about his response, which is what I would respond as well if I was asked, which is basically to focus on the trends. And I think Elliott Wave counts can be really helpful to put a structure behind what you're saying. At the end of the day, though, focus on the trends. Our next question, let's get to it. What is the reason you use the 5, 21, and 34 exponential moving averages on your weekly charts versus other moving averages? Really good questions. This is what I call my market trend model. I created this years ago, and I've just kept it going for a long time. For me, I wanted to have a market trend model. For me, a model is not an output of my process. I would never run any money based purely on a model like this. For me, models are an input, just like a lot of other things are inputs. And then you aggregate all those inputs, and you just determine what the overall weight of the evidence is. So for me, the market trend model is based on weekly data. I update it every Friday. I look at it occasionally, but I try not to midweek. I just try to bring it up after the close on Friday to see how things have evolved Friday to Friday. So that is part of my process of taking a step back and getting away from the short-term movements and thinking about the long-term trajectories. The weekly model for me is based on the 21 and 34 week exponential moving averages. And, over my career, I've met a number of people that use longer term moving averages. Ned Davis famously has a big MO model, a big momentum model based on the 13 and 34 week exponential moving average. I experimented with a bunch of different combinations, and 21 and 34 was a pretty good representation of the type of trends I was trying to capture, and that's why I went with it. The 5-day exponential moving average for me is more of a shorthand. I found on a weekly chart, I wanted a quick gauge of what the short-term trend was, and where the price was on a Friday close versus the 5-week EMA was pretty good enough for me. If I'm really trying to understand the short-term dynamics, I usually look at this chart, the daily S&P chart. So that's more of a placeholder to understand it. And why those particular periods, 5, 21, and 34, they come from the Fibonacci sequence, and a lot of technical indicators, even DeMark's indicators that if you saw on Katie's charts, it had the 9 and the 13. Tom actually originally started with an 8-day setup and a 13-day countdown. Those are Fibonacci numbers, and you'll find those with a lot of technical analysts. They kind of proliferate around your settings at times. Next question. It seems the RRG would be an effective way to decide what to buy when. If weekly RRG is in the green and daily is also in the green, the sector is outperforming the S&P 500, both long-term and short-term. Why not buy? What am I missing? And that's part of a longer question that you asked me, and it was really focused on the actionable conclusions you draw from the RRG. And I'll tell you what, Julius DeKempener, who created this visualization, years ago when I first met him and he showed me this, I remember asking him, all right, so how do you use this? Like, what, do you have a system based on this? And he's like, he was very immediately told me, it's not a system. I didn't want a system. I wanted some way to visualize sector rotation. I have tools that help me time trades and have tools that help me think about how to allocate, but I didn't have a way of visually understanding how sectors were rotating around the benchmark. And he created the RRG to do it. So what I have found is that while I would encourage you to experiment, and I know Julius and me and others have tried different things to look at how we might try to turn these into some sort of system. Do you look at things where they're going a certain direction? We've looked at the distance from the zero line, the length of the tail, all sorts of different things. And I would encourage you to experiment on your own and see if there's something, if there are inputs that fit into a bigger trading system. But for me, it is less answer the question of what should I own, but answer the question of what chart should I look at. This tells you that financials are starting to improve on the longer term time frame, and it tells me to dig into that sector a little more to see what's actually causing some of those up moves. So that would be my answer. I think it's less about, is there a way to use this to identify strong trends? I think that's absolutely right. I think for me, it's more of what you do with that information. And for me and for Julius as well, who created this, it's more of a way to making sense of things visually and then help you understand where you need to focus your attention. And a lot of times what I would do with money managers is cover up sort of the middle and just look at the outliers. What are the parts of your portfolio that are really causing some movements? And remember, you can put a watch list on the RRG and see how the watch list is rotating around a benchmark in the middle. That's it for our mailbag segment. Again, shoot us your questions via email, thefinalbar@stockcharts.com. I hope to answer one of yours on Friday's show, but we need to wrap today's show and go to the 3 in 3 charts in 3 minutes. Here we go. Chart number one is the chart of Bitcoin. And I was asked in an interview last week about upside prospects for Bitcoin, and I told them two things. Number one, I am very confident that Bitcoin could go much higher than it has already. I think that is justifiable given the technical scenario. And if you look at the historical swings and the type of volatility Bitcoin has had and what it has done before it's gone to exponential rises, it looks a lot like what we've seen in the last 6 months for Bitcoin. So I'm not surprised we've had a pretty decent pullback of over 50%. I am equally not surprised we have retraced that pullback 100% and gone back to the previous highs. But my second point is, but we have to get above the resistance from March, April, and May. This is a major 3-month top that we are now in the middle of. I would not be surprised if we go further, but I would also not be surprised if we have some backing and filling until we can power through that resistance level. Now, everyone now is basically in the green. If you bought Bitcoin at any point in history, you are now at least marginally in the positive, and that's going to feel pretty good to investors. And I think that is what most likely propels Bitcoin to further highs from here. The second chart is airlines, and I've been asked about airlines, particularly when transports start to look good and the UAL is getting above its 200-day moving average. And I'm asked, all right, is this the time to get back into airlines? And the problem I have with the chart of the UAL or most other airlines is the fact that the relative strength has just been so consistently weak. It's not a question of whether this is an interesting time to maybe get into airlines. I get the idea of buying into it as an idea of getting into something that's pulled back and the potential that the economy further reopens and people are a lot more comfortable traveling and airlines do well. But from a technical perspective, with the relative strength going down so consistently, it just tells me there are better places to be. And I'm not struggling to find stocks that are breaking out. Stocks that have pulled back to actionable levels, like something like Facebook that Katie Stockton mentioned earlier, and charts like this that are going down do not fit into that playbook for me. So I'm not a huge fan of airlines until they show further signs of accumulation. Where I am seeing an interesting move is with Plug Power. Renewable energy equipment was the #1 Dow industry group today. Plug is an interesting one. This had been one of the better stocks of 2020, particularly going into January. From there, it gave back a lot of those gains. Now bouncing higher, bounced off of the 200-day moving average a couple of times, and we're facing resistance around 35. This is where we hit resistance in June and July. Can we get above those highs? Folks, that is our show for today. Thanks so much for joining us every weekday after the close, and a special thank you to Katie Stockton from Fairlead Strategies joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.